It usually begins with a knock at the door or an unexpected phone call. The person on the other end sounds official. They may say they are working with the local utility, helping residents enroll in a government energy program, or identifying homes that still qualify for a limited net metering opportunity. They may already know the name of the utility company and enough about local electricity rates to sound convincing. Then comes the request. They need to see your electric bill. They may describe this as a routine eligibility check. They may say they need to confirm your usage, verify your account, or determine whether your home qualifies for lower rates. They may insist that they are not selling anything. They are simply there to explain a benefit that has already been made available to you. That is often the first deception. The use of real concepts, mischaracterized as opportunities. Net metering is presented as though it creates an equal exchange between the homeowner and the utility. In many cases, it does nothing of the kind. The homeowner purchases electricity from the grid at the full retail rate, then receives only a fraction of that rate for the excess power sent back. The sales pitch calls this an offset. Economically, it can amount to buying high and selling low while carrying the cost of the equipment, financing, maintenance, and installation. Solar energy is also real, but the homeowner is also being asked to make a permanent alteration to the property based on technology, pricing assumptions, and utility policies that change on a near-annual basis, long before the contract ends. What is marketed as energy independence can instead become a long-term commitment to aging hardware and an economic model the homeowner does not control. The scam is the use of those legitimate concepts to create false authority, false urgency, and false expectations. First, the salesperson wants the homeowner to believe that the utility sent them. The homeowner is encouraged to see the conversation not as a private sales solicitation, but as an official visit connected to an existing public program. Once that premise is accepted, the salesperson no longer has to earn trust. They have borrowed it from the utility company, the government, or the general public's belief in clean energy. The language is carefully chosen. The representative may say the company is working with the utility rather than directly employed by it. They may call themselves an energy consultant, an enrollment specialist, or a program representative. They may say your neighborhood has been approved, selected, or opened for participation. Each phrase is designed to imply more than it actually says. The Federal Trade Commission has warned consumers about solar sellers and clean energy imposters who falsely claim government or utility affiliations, promise unrealistic savings, and pressure homeowners into expensive agreements. These are not harmless misunderstandings. A misleading conversation at the front door can lead to a financial obligation lasting 20 or 25 years. The request for the electric bill is especially important. A utility bill contains more than a monthly total. It can reveal the customer's account information, electricity usage, rate plan, and service address. It gives the salesperson the data needed to construct a highly personalized pitch. Once the salesperson knows what the homeowner currently pays, the proposal can be designed around that number. The conversation stops being about the true cost of a solar system and becomes a comparison between two monthly payments. The homeowner may be told, "You are already paying the utility company $200 a month. Instead of giving that money to the utility, you can put it towards something you own." That statement can conceal nearly every important part of the transaction. The proposed solar payment may be the first payment on a long-term loan. It may be a lease payment for equipment the homeowner will never own. It may be a payment under a power purchase agreement, in which a third party owns the panels and sells the electricity they generate back to the homeowner. In each case, the arrangement can create a second energy bill rather than eliminate the first one. Solar panels certainly produce some energy, and on a clear, sunny summer day may even offset current usage, but the homeowner will continue to receive a utility bill. Solar panels do not produce electricity at night. Production falls during cloudy weather and decreases in other seasons. Utilities impose fixed monthly charges, grid access fees, or other costs that remain regardless of how much electricity the panels generate. The homeowner now owes money to the solar company, the lender, or the system owner, while still owing money to the utility company. This is how no money down becomes free solar. Those phrases are not equivalent. No money down usually means the customer is not making a large payment at the time of installation. It does not mean the equipment is free. It does not mean the electricity is free. It does not mean there is no financing cost. It does not mean the customer will never receive another utility bill. A homeowner may be committing to tens of thousands of dollars in future payments while being told only that there is no upfront cost. The same distortion appears in promises of a $0 electric bill. A solar system may reduce the amount of electricity purchased from the utility. Whether it eliminates the bill depends on the system, the household's consumption patterns, the utility's tariff, and the value assigned to electricity sent back to the grid. That last issue is where the phrase net metering becomes particularly useful to an aggressive salesperson. Many consumers assume that every unit of electricity sent to the grid will cancel one unit purchased from the utility later. In some places, that may be close to how traditional net metering operates. In other places, the arrangement is better described as net billing. Under net billing, the customer may pay the full retail rate when purchasing electricity from the grid, while receiving a much lower credit for excess solar electricity sent to the grid. The difference can be substantial. Imagine that a home sends excess electricity to the grid during the afternoon, and then purchases electricity from the utility after sunset. The salesperson may describe those transactions as if they perfectly cancel each other. But the utility may credit the exported electricity at only a fraction of the rate it charges for the imported electricity. The homeowner could sell electricity cheaply during the day and buy it back at a much higher price at night. Even when the system produces as much electricity as the household consumes over an entire month, the bill may not disappear. The timing of production and consumption matters. The export rate matters. Fixed charges matter. Seasonal variation matters. A sales presentation that discusses only annual production and annual consumption can conceal those realities. A legitimate financial analysis should consider when the household uses electricity, when the system will generate it, how much power will be consumed directly inside the home, and how much will be exported. It should account for shading, panel degradation, weather, fixed utility charges, maintenance, financing costs, and possible changes in electricity rates. Instead, the homeowner may receive a colorful proposal showing a dramatic line rising upward over 25 years. That line often represents assumed utility rate increases. Those savings are not money already earned. They are predictions based on a series of assumptions. The homeowner may be shown a large lifetime savings figure without being told how much of it depends on future rate increases, uninterrupted system performance, favorable utility policies, and the homeowner remaining in the property for decades. The financing can be even more difficult to understand than the energy calculation. Solar-specific loans may be advertised with surprisingly low interest rates. What may not be clearly explained is that the amount financed can be substantially higher than the cash price of the equipment. A system that might cost $30,000 in cash could be financed at a much higher principal because of lender fees, dealer fees, or other embedded charges. The customer then pays interest on the inflated amount. The Consumer Financial Protection Bureau has warned that some solar loans include hidden or poorly disclosed fees that significantly increase the loan principal. A low interest rate may therefore distract from the more important question: how much is the homeowner actually borrowing? The salesperson may never volunteer the cash price. Instead, the homeowner is shown a monthly payment. That payment may be compared to a recent electricity bill and presented as immediate savings. But a monthly payment cannot be evaluated without knowing the term of the loan, the amount financed, the interest rate, the fees, and the total amount that will be paid over the life of the agreement. Some solar loans have also been structured around an expected tax credit payment. The customer may be shown a low initial payment based on the assumption that a large lump sum will later be applied to the loan. If that lump sum is not made, the monthly payment can rise. The customer may not fully understand that structure. The salesperson may describe the tax credit as if it were an automatic rebate or a check guaranteed to arrive. A tax credit is not the same as a rebate, and eligibility depends on the law and the taxpayer's circumstances. There is an additional concern for sales occurring in 2026. The Federal Residential Clean Energy Credit, which was previously associated with many homeowner solar installations, is no longer available for expenditures made after December 31, 2025. State, local, and utility incentives may still exist, but a salesperson presenting the old federal 30% homeowner credit as universally available is using outdated information. That doesn't prevent a salesperson from including the supposed credit in a proposal. It only means the homeowner may discover the problem after signing. The urgency of the pitch helps prevent careful review. The salesperson may say the utility is closing the program, that the neighborhood has only a few remaining approvals, that the rate will change the following day, or that the government incentive is about to expire. The homeowner is told that signing immediately preserves eligibility and that the documents can be reviewed later. Sometimes the signature is collected on a tablet. The salesperson scrolls rapidly through pages of legal language, stopping only where initials or signatures are required. The homeowner is told that the documents merely authorize a site inspection or reserve a place in the program. The document may actually be a binding purchase agreement, a financing contract, a lease, or a power purchase agreement. By the time the homeowner receives the full paperwork, the system may already be moving through design, permitting or financing approval. The consumer may then be told that cancellation is no longer possible, or that cancellation requires payment of substantial fees. Certain door-to-door transactions may carry cancellation rights under federal or state law, but those protections can depend on the circumstances. A homeowner should not assume that every solar contract can be cancelled at any time simply because the sale occurred at home. The safest time to reject a bad agreement is before signing it. Homeowners should also consider what happens when the property is sold. A long-term solar obligation does not necessarily disappear when the owner moves. A buyer may be asked to assume the loan, lease, or power purchase agreement. The seller may have to pay off the obligation, purchase the system from the owner, or negotiate with a buyer who does not want the arrangement. Equipment installed on the roof may also complicate roof repairs, insurance claims, or replacement work. A salesperson focused on closing the transaction today may not spend much time explaining what happens 10 years later. The deception succeeds because each part of the pitch reinforces the others. The claimed utility connection creates trust. The government program creates legitimacy. Net metering creates the promise of financial value. The electric bill provides the numbers needed to personalize the presentation. The zero-cost claim reduces resistance. The tax credit claim makes the price appear smaller. The deadline prevents independent investigation. By the time the homeowner sees the contract, the decision may feel as though it has already been made. That is why the most important protection is to slow the process down. An unexpected salesperson should not be given access to a utility bill or account number. Any claimed relationship with the utility should be verified by contacting the utility through its official published telephone number. Any government program should be identified by its exact legal name and confirmed through the agency that supposedly administers it. The homeowner should obtain the system's cash price, the finance price, and the total amount payable over the entire contract. The proposal should identify who owns the equipment, who is responsible for maintenance, and what happens if the system underperforms. The utility's actual export compensation should be confirmed directly with the utility. The homeowner should know whether excess electricity receives a retail credit, an avoided cost credit, a wholesale-based credit, or some other rate. Fixed charges and non-bypassable fees should be identified. Any promised tax benefit should be reviewed independently. Any claimed savings should include both the solar payment and the remaining utility charges. The contract should be read away from the salesperson and compared with competing proposals. No legitimate 25-year financial commitment becomes a good deal merely because it is signed quickly. Solar energy can be beneficial. It can reduce electricity purchases, provide a degree of price stability, and allow homeowners to generate power on their own property. But the value of a solar system depends on the details, and those details are precisely what the deceptive pitch attempts to avoid. The salesperson wants the homeowner to hear a simple story. The utility sent us. The government is paying. The panels are free. Net metering will erase the bill. The offer ends today. That story should be treated as a warning. The real transaction is more complicated. It may involve a private contractor, a separate finance company, a long-term obligation, uncertain future savings, changing utility policies, and equipment attached to the home for decades. The panels may produce electricity for 25 years. A bad contract can produce consequences for just as long.